Hey guys, welcome back to the Retail Compass. So it's been a while, and because life has been pretty busy as of late, and I realized it's pretty hard to consistently put out a kind of educational 10 minutes kind of videos weekly, as it just doesn't really fit my schedule well. But I still want to continue putting out videos for you guys, sharing my thoughts on the markets. So I'm decided that I'm going to do something more timely. I'm going to post kind of more of these short market updates, hopefully 2 to 3 times a week, or whenever there's big things that happen. And whenever there's a very timely topic, or when I have more time, I'll put up those usual longer videos on the markets where hopefully I can also share with you how to think about the markets through these videos. So alright, let's look at what has been happening in the markets these days. So the last week, we could clearly, see that the market has sold off about 3%, since the last highs. So this price action is, in my opinion, pretty bearish in the short term. Why do I say that? Because if you look at when we last closed below the 50-day moving average, we go all the way back to May. Since then, the S&P dip buying structure has been so strong that we haven't actually closed 2 days in a row below the 50-day moving average. So, I mean, today, still don't know yet, but looks like it's going to close below the 50-day moving average as well. So right now, I would say be cautious. Don't buy the dip yet. Because why? If you look at where major dips are really formed, after in a kind of weak downtrending market. If you look at this dip, this is not counted, right? Because this dip, we are still in an uptrending market. So it's okay, to buy dips in an uptrending market. But right now, I would say the market is in quite a jittery place because we have Nvidia earnings coming up. Wednesday after close, and we have probably BLS jobs market data coming on Thursday, right? So these can really move markets either way, and right now price action is telling us that we are actually in a sell rallies regime, because that's probably what institutional investors are doing as well. They're taking advantage of rallies to sell and reduce their exposure at these levels, right? But again, where then do we start buying the dip? If you look at the next natural level, right, it will probably be somewhere around here, 6,550. So that's where the 100-day moving average is. And the last time, if you remember, I talked about supports and resistance. This also coincides with the last kind of decent support where we seen buying come in right away. So all these people who kind of missed buying over here will likely use the chance to add exposure at around this level, right? So this is the first kind of support to look out for. Before that, it's really quite iffy to buy right now because there's just no, catalyst, right? For sure, I mean, market may bounce back, but you would rather wait for an uptrend to be established if you're trying to go long. So that's my view right now on the SPX. And also one thing to note, if somehow we really get bad news and we burst right through this 6,500 levels, then I think in the short term we may see more downside, because again, the quant systematic funds, right, they are trend following. So once we break this 100 DMA support level, these funds who are currently, I would say, still long the market are going to turn short, and they are going to be a powerful force, driving the market. So we could see a further downside, to maybe even 6,004, 6,003 levels. But I personally would say that we probably wouldn't, get a 10% sell off from here. Why? Because firstly, we are already at fear level 37 right now, right? Usually, we when fear level is already this high, we don't see like, it's very hard, I would say, to see a very big sell-off. So this is one indicator I'll look at. The other one is this, basically. How many stocks are trading above their 20-day moving average, which is basically a gauge of short-term strength. So right now, only 31% of it is of stocks are trading in short-term strength. And usually when we near the bottom, it's probably around 10. If you look at history, Liberation Day is around 10. Last December, where we had the Fed kind of sell-off driven, is around 10. And yeah, so maybe let's shift to a higher time frame. We can see it clearer. Yeah, so you see, when we have 10s, usually that's when market form a medium-term bottom and start rebounding, right? So right now we are, I would say, closer to the bottom of the range than the top, which was, really somewhere above 60, 70. So I think we are at the middle stage, of correction. We are in the middle, not at the beginning, but not at the end. So just wait for the market to either hit, 6,500, or if we really break through, then wait a bit more. Or if Nvidia really delivers, blowout earnings and we re-establish the uptrend, then start to buy on dips as well. Markets are all about probabilities, never certainty. Always try to, trade in a way that the probability is in your favor. So if you really want to try and look for, other assets where there's kind of a clearer direction, I would say maybe gold is one that you could potentially look at, because gold, I think we are still holding quite decently in uptrend. I mean, of course, it will be tough, to break out of all-time highs in the near term, but I think if we, get to 1 or 2% lower, around 3950 levels at 50 DMA, where it has not been tested yet since its big rally since September, I think this is likely to hold, because usually when we test it, the first time it tends to hold because the buyers are not absorbed yet. So I think if you're looking for a short-term trade, this is a level you could look to enter. And yep, that's all I have for you guys today. Stay tuned for the next one, and trade, invest safe. Remember, don't chase the levels, let the levels come to you.